All right, welcome into the podcast, y'all. I'm Dr. Alex Sengar. I'm here with a good friend who's going to help us understand how to approach multifamily real estate investing. And we've talked a fair bit about kind of where do you take your money after you acquire it in your business. Obviously, on this podcast, we focus a lot on keeping money. We're going to have a discussion today about what do you do once you've kept the money? How do you make money, make more money? Which is that's the ultimate for Will and I, as we're doing this show, as we're working with clients, that's the ultimate destination that we're all trying to get to anyway, as business owners, is get to the point where your money can be working as hard or if not harder than you. And so we brought in a good friend and expert today, Andrew Brough, to educate us, mostly me, on multifamily real estate. And I will fully admit that I have no clue about any of it. And so hopefully if you're listening along today, and you don't feel like you have a good grasp on it, you'll feel a lot better by the end. If you do have a good grasp on it, we're going to start to get into some numbers today of what do you look for in deals. Andrew has a lot of experience putting deals together, pulling in investors, and just a really down-to-earth guy too on helping to explain this stuff. So as I started to pick his brain a while ago, I was like, dude, we just got to record this conversation, and I think it'll be really useful for people. So Andrew, welcome into the show, man. So happy to have you here. We've been longtime friends, and I'm so glad we're finally having this conversation.
Yeah, thank you, Alex. It's a pleasure.
Yeah. So I want to know, before we get started, or I guess as we get started, how did you get into multifamily real estate? Because this isn't something that like you were born knowing. Clearly, I remember when we were first having conversations about this years ago. How did you start to get into this and feeling like, oh, I want to learn how to invest in multifamily. I want to understand that as an asset class. What's your story about how you got here?
Well, I'll back up a little bit. So I started in banking. I've been in banking about 23 years, mostly in commercial lending, and I think that's the major springboard for me getting into it. I did rent a property back in, I think it was 2005, 2006. It was we basically swapped houses, and we rented the house we sold, or we rented the house that. We bought the individual's house, and he rented our house, so our other house, and then we sold that a year later, and I just continued in my banking career for a while. Didn't really get into real estate investing, just until I started seeing the benefits that my members were realizing from these investments, and net worth, liquidity, it starts to grow, and I thought there's something about this, and so in 2018, I started to investigate it more. Had some customers that I talked to, and they said, "Well, you need to get some education." I'm like, "Well, why do I need education? I'm underwriting these commercial loans, commercial real estate deals." So but I did. I got some group coaching and started the process. Started contacting brokers and underwriting deals, joined some groups that, they have some spreadsheets and different things and some learning tools to kind of understand, because in commercial lending, there's only a few factors you look at, like debt service coverage ratio and debt yield, loan to value. But when it comes to real estate investing and dealing with investors, there's a lot of other factors. There's internal rate of return, cash on cash, when do you exit the deal? There's just so many different variables. So that was, it was good to get in and get some education and kind of understand what it all takes and how it all works. And that's, and then in 2018, I started doing that. And what I decided to do was invest in some of these real estate deals as a passive investor to start, just to kind of understand what's under the hood, what's going on with it. And so in 2019, I invested in one myself, and then in 2020 as well. And then in 2021 is when we were able to finally buy our first property.
Very cool. So at this point, if you're okay asking, how many doors do you have then that you're managing at this point?
I have ownership in 531.
So it's so cool, man. It's really cool. So I'm coming in as a small fish who doesn't understand multifamily. I've got my one single door from our one single rental property that we've got. And hearing that number of 530 plus doors is just totally mind blowing. And for a lot of investors in my shoes, it's like, whoa, I can't even wrap my head around that. I maybe don't understand the commercial multifamily real estate side of things. Help ease my fears a little bit, because I hear I've got 531 doors and I think about our one door that we have. Now, granted, it's not all that complex. We have a turnkey rental property manager that just does everything for us. But that seems really complex when you look at what you're doing. Help me bridge the gap here from someone who I can understand single family houses. Understanding multifamily is hard. Can you dumb it down for me as we look at it? Like how sophisticated do I need to be as an investor to feel confident investing in multifamily like this? Like, should you, I mean, you can full out tell me, Alex, don't do it. You're too stupid, which is fine. But what do I need to understand about multifamily to be able to feel comfortable investing in that as an asset class?
Well, there's certain benefits for investing in multifamily. So single family rentals, you have one tenant. If that tenant moves out, you don't have any more, you don't have any.
Right.
So with the multifamily, some tenants move out, you still have income to support your loan and provide cash flow for operations. So there's some benefits there. It's really not too difficult to understand. I mean, conceptually, with the single family rental, you still have your cash on cash returns, your annualized average returns. So there's, those are the same. It's just I guess on a larger scale, it could be 20 units or 50 or 100. So it's not too difficult if you can understand a single family rental investment. It's just kind of multiplying it by the number of doors you buy.
Right. So it feels like with a multifamily unit, I guess the types of deals that you're talking about are investors usually pooling with other investors to get those kinds of deals? Or is it more common to have someone say, hey, I'm going to go start with I don't even know, 50 door apartment building on their own to buy it outright? Like what's the norm in your world that you see right now?
No, yeah, usually you have to get some help. You need a team to do it. It's hard to do it by yourself, and especially managing the property if it's multifamily. You need some people will manage it themselves, which is difficult.
I
Most
would
of
not
us
want that
it's a
job.
full-time job.
Yeah.
I mean, I think I have one customer that I think 150 doors, he manages them himself, and that's as much as he can do.
I'm
So
sure. Yeah. Which
it's just
then stops being a passive investment, right? Then it's just a job.
it's job. Yeah.
Yeah.
Right. Yeah.
Okay.
So you do need to have a team of people to do it. Maybe someone's good at contractor work and working with contractors, and maybe they're a contractor themselves, and people who can manage tenants and different things. There's a lot of different variables that go in, and having a team is usually the best way to do it. Some
Love it.
people come into money and they can just buy one by themselves. But generally I see people partnering together and
Okay.
buying one.
So we talk a lot about the numbers and the reality of things on this show. So I want to dive into some numbers again from an idiot standpoint like me, that I can understand buying a single family house. I know that I'm putting 20% down usually, and then I can invest. I can get a bank loan for the rest. Let's talk. If someone's looking at getting into this game, what are the minimums for how much they need to bring to the table cash wise? So just starting there, because I know on a single family, I could bring, $20,000, $30,000 to the deal, and I can get $100,000 or $150,000 house on the low side. What about for multifamily stuff? Kind of where are we looking at? I'm sure there's a range, if it's 4 doors versus 100, but what do you recommend someone start with from a cash standpoint?
But usually, down payment is going to be, that 20 to 25% or more.
Okay.
Depending on, the project. If you're buying the asset and you're going to renovate, and say there's not going to be really strong cash flow initially because you're renovating units and occupancy is going to go down. Maybe your down payment needs to be a little bit more in the 30% range or more. So it just depends. It's I guess in a way it's like a single family rental. You still have the debt you can get is in the loan to value is going to be your 70, can be up to 80%. I think as time goes on here with the economy, probably won't be seeing a lot of 80%.
I was gonna say, do you think it's moving more towards having a 75 or 70% loan to value realistically for bigger deals like that?
Yeah.
Okay. Yeah. So I need to bring 20 to 30% down. What does that look like? How much cash are we actually talking? Kind of the scope of deals that you deal with, how much cash does that actually look like then?
So I mean, a $5 million purchase, you're talking 1.5 million.
Okay. So someone hears that and they think, oh my goodness, I'm nowhere near 1.5 million. Does that mean I shouldn't even look into multifamily at all? I mean, is that the minimum that I should be willing to bring, or can I get a smaller deal size and still participate in that asset class?
Yeah, I mean, there's different size of properties. I mean, you can find a 20 unit or something smaller and you can get into it. You can also, as we do, pool money together. You can find investors and that can help bring in some of the cash.
Cool.
To buy it.
Yeah. So is there a minimum that I should be looking to bring if I'm pooling with other investors? What's kind of the minimum threshold that they say, hey, you can bring 25 or 50 or 100,000 of cash and we'll let you in? What's that baseline?
Usually it's 50,000.
50. Okay.
If you're doing a syndication, usually it's 50,000 minimum. Some larger, 200, 300 unit deals, your minimum is probably gonna be 100,000.
Okay. So I need to have 50K liquid cash. Is there, just like with rental properties, single family, you need to bring reserves to the table too. So if you don't have, if a toilet breaks or you have a renter, you don't have someone in there paying rent, you got to have reserves. Do I need to bring reserves to the table as well with a deal like this, or is that usually covered with that 50K and everyone pooling resources?
So usually there's going to be a renovation budget.
Okay.
There's going to be reserves that the lender will require. There will be, in some cases, there's an interest reserve as well.
Okay.
Cover interest payments. And so, you can lump all that together, including the down payment. And then you find enough investments to cover all of that.
Okay. So would the 50,000 that you mentioned generally cover all of those, both my down payment and reserves and renovation budget, or would it be in addition to the 50?
Well, if you have, it wouldn't, I mean, the 50 would just be an individual investor.
Right. No, exactly. I'm just looking again from my perspective. Do I need to bring 50 or do I need to plan? Oh, it's got to be at least 60 or 70 to cover renovation and all the other stuff if I'm pooling.
Per investor is just
okay.
50, and we'll
cool.
just bring in additional investors to bring it to make sure we have enough.
Okay. So let's say I've got 50 grand sitting in the bank. I'm really interested in owning a multifamily unit. And how do I do it? Is this something where are there, in the turnkey world, it's like I can go find a turnkey real estate provider. I maybe connect with someone who, a real estate agent, they find me a single family dwelling that I can go buy. What about in the multifamily space? Is it, are people coming to you and you're finding the deal for them? Do they need to find the deal and then come to you for the financing? Like logistically, how does it work? If I say, yes, I've got money, I want to participate in a deal, where do I go next?
So, I mean, we provide deals. We have deals that people can invest in. I don't know if we call us a turnkey provider, but I mean, we have deals to invest. They're, finding a deal is challenging, especially if you're just getting started. Part of that is, if you're, usually a lot of brokers have relationships with these owners. And so being able to break into the broker, I guess, getting a broker to trust you and give you a deal that that is worthwhile buying, it's challenging initially. So we have those relationships, and we can provide those.
Cool. Okay. So someone comes and works with you, you provide the deal. And then at that point, how hands-on or hands-off is it for me as an investor? Is it as hands-off as I give you $50,000 and then you or someone else that you're affiliated with is finding the contractor, they're getting the property manager? Like, how hands-on do I have to be if I were to work with someone like you? Is it pretty like, no, it's pretty much passive from there and we have the team that takes it, or do I need to go still kind of put pieces together as the investor?
No, it's purely passive.
That's so cool.
Passive.
Okay.
So, like with single family, I looked into single family investments, and even when you buy those, sometimes you have to get involved, and something breaks, you still have to kind of fix things. There's still some involvement in some of those.
Sure. Depending on what kind of company you hire for management and stuff. Yeah.
Right. And so for us though, no, I mean, it's purely passive. And I mean, there's a lot that goes on operating a property, and we just handle all that.
Very cool. Okay. So let's talk some numbers then for a minute in a deal. Is there a certain percentage that I need to plan on? Like, I guess since I'm going into whether it's a syndication or whatever, I'm putting my money in, and then let's talk a few things. So first of all, liquidity. How liquid is my cash versus am I saying, no, it's going to be in for a term of 10 years? Like let's talk liquidity first of all. How does that work?
Yeah. So velocity of money invested.
Can you describe that for us? Because a lot of people will be like, whoa, what was that?
Well, basically, it's just how quickly your money turns. So you invest in something, and how quickly do you get it out?
Yeah,
and can invest in something again. So, give you an example. We just our first deal we bought in 2021. We went in, renovated units. And by the way, our rents are 30% plus more than what we underwrote.
Oh, wow.
It's been a great investment. And so with that, we just refinanced our loan, and we're likely going to be able to return 100% of the investor's capital. And that's in, less than 2 years.
Wow.
Usually, so what we do is we'll buy a property and do the same thing. And in year 2 or 3, we'll refinance and hopefully return as much of the investor's money as possible to invest in something else. That is tax-free cash.
Now, do I need to roll that cash into, like, do I need to do the whole I don't even know what it's called. Is it 1041, 1091 exchange? Do I have to do all that jumping through hoops, or is it just like, oh, I get the cash back because it's cash I put in and it's tax-free?
On a refinance, you do not have to do 1031. No, that's your
Cool.
cash. You can keep it if you want. You can invest in something else. You can do whatever you want with it.
Okay. So that money's tax-free. Do I keep getting the payments from the monthly rents if we do a cash out refi? I'm using these terms loosely because I'm an idiot in this realm. If I get the cash out from a refi that you guys do I still keep collecting rents?
Yes, you still are owner. You're still an owner.
So then it's all basically 100% profit after that.
Yeah. I mean, if you get 100% of your cash back, then your cash on cash is infinite.
So realistically, Andrew, with the economy today, because things are changing over the past 2 to 3 years, market values have gone, straight up or at a very steep curve. And so it's really easy to go refinance, pull out all that cash and say, here you go, guys. Let's talk realities of where we're at right now. And I know that nobody knows, but I would imagine that it's not quite as reasonable to expect in 2 to 3 years we could go do a refinance and pull out all that initial equity to return it to investors. Is that time horizon probably going to get longer, or would you guess it's going to get longer in the next few years with just kind of where values are going?
Well, I think it'll be the same. And the reason why is because rents are still going up, and we still have a housing crisis, a shortage of housing.
Right.
And with rentals and multifamily, those rents are going to continue to go up. I mean, yeah, I guess realistically, if rents went down, but right now there's, at least in the markets we work in, Utah, Idaho, Arizona, Texas, and Florida, Georgia, the Carolinas, these growth markets, there's a housing shortage, and
Yeah.
and because of that, I think it's going to continue to be, continue to see what we're seeing. Their interest rates is the biggest factor in all of that. Is what will rates be down the road, and rates right now are climbing quite quickly, and
Right.
so yeah, I guess as far as that goes, there could be, maybe you wouldn't get the 100% back, maybe you get 75, but
Yeah.
I think I think refinance or getting a supplemental loan, which is basically a second lien on the property, is still possible.
Wow. So again, I'm coming in as a total idiot in this. Is it normal for people to be able to, like, the 2 to 3 or maybe 4 years out? Is it kind of the standard that, hey, we're gonna get in this, we're gonna buy the property, and then we're gonna refinance it? Is that kind of just industry standard, or is that just because you've got such amazing deals that you've got
That's
into?
that's our focus. I mean,
Okay.
not everyone does it.
Yeah.
Some will buy it. Like a lot of my customers, they'll just buy it and hold it,
Sure.
for a long time. But that's our focus. We like to get in, either we get in, renovate, refinance, or get in and sell. So
Very cool.
in about 3 years.
Yeah. Okay. Let's talk. I know we've only got a couple minutes because I promised I wouldn't take up too much of your day. I'm fascinated by this. This is really interesting. So let's talk cash on cash return expectations. In the single family world, a lot of people say, well, you can expect somewhere between 10, 15, maybe 20% cash on cash. And that's kind of where our numbers have been. I'm curious for a multifamily, what should I expect? If I'm putting in, again, let's say we're starting it at the minimums, and then it obviously can go up from there. But if I'm putting in 50K, what would I expect to return? I'm sure the math is really hard on this, but just in general, what would I expect for a cash on cash return?
Usually the first year, if, the way we do it, we're going to renovate each property. So usually
Okay.
the first year it's not as strong. It's 2 to
Sure.
3%, but we do a preferred return of like 8%. So that accrues and is due and payable when there's a capital event for the next year.
Can you define all those words you just used?
Yeah. So basically, you still, preferred return means that the investors get that return before the general partners get paid.
Okay.
So we have to pay that. It's almost like a loan in a way. You have to pay that before you pay, before the general partners get
Before
paid.
there's any payout to general partners.
Right.
So it's sort of like this is probably a bad analogy, but like the cliff, right? It's like, hey, you have to get paid back as the investor. You have to get paid back your 8% on, I would assume, your initial investment. And then after that, then the general partners, AKA the people managing the funds, you guys get paid back after that. Is that how it works?
Yeah, that's how it
Sweet.
works.
Okay. I can understand that. So year one, 2 to 3%, but then there's that 8% preferred return. Year two, what is an average estimated cash on cash return looking like?
Then it starts to get up to 7-8%.
Okay.
Year three, if we do a refinance, then it's really strong. It's, very strong cash on cash. So, and then four, I mean, you're getting up into that point, year 3, 4, 5, you're getting into the 10% range, 10, 11.
Yep. Okay. So let's say I put 50 in, I'm going to run. We are at the half hour mark that I promised it out. Do you have a couple more minutes or do you need to boogie?
Yeah, I'm good.
Okay. We'll be short here. So let's say I put in 50,000. I'm using my 5-year-old math here. First year I put in, I get 2 to 3%. Let's call it 3% times 0.03. Whoa, syntax error. I'm terrible at math off the top of my head. So there we go. So it's like $1,500 that I might expect to return back over the course of the year. Is that accurate?
Yeah.
Okay, because we're doing renovations, right? We're improving the property, etc.
Right.
Let's say by year two, I'm at 7%. So 50,000 times 0.7. it's like 3,500. So monthly, I'm looking at like $300 a month by year 2. Then by year 3, I might be up at 10%, which puts me at somewhere around $5,000 if I put 50 in, which over 12 months is more like 400 a month. But then at that point, I'm very likely to have gotten my initial capital investment returned through a refinance.
Some of it, yeah.
Some of it. Okay.
Some are all, yeah.
Wow. And then from there, it just keeps cash flowing, and you just never sell it unless you really want the payout. Is that kind of how it works?
Well, yeah, we usually will sell in year 5, but yeah,
Okay.
I mean, you don't have to. You can, if you have all your cash back, you might as well just keep it.
Right. I mean, you're just sitting there cash flowing with no capital invested. It's essentially at that point, it's just pure profit. And then you can go decide to buy again, etc. Wow. That's really interesting. Okay. So it's actually quite different from single family in terms of the logistics of how the money works.
It is different. With syndications, the preferred return comes into play. There's also waterfall returns. I mean, there's it can be kind of complex,
I'm sure,
as far as returns, but generally, I mean, I had a partner that he had single family rentals, and he's like, I can only get about 200 out of them a month, and well, that's I guess it's a little bit similar. And as far as doing it yourself, I mean, ours is passive, so you can just invest in it, sit back, it's called mailbox money, just sit back and let it come in, and
right.
And if you get a refinance in year 2 or 3, and you can invest it again, and just kind of snowballs.
Very cool. Well, I know we've talked about all the rosy parts of it. I'm sure that there's some like, hey, let's make sure that you know X, Y, and Z before you go into this investment. Didn't really have time to get into that today. I just wanted to understand from a high level. It helped me understand the asset class, and you've done a great job with that today. I pulled out some cool things that I didn't understand beforehand, which are, number one, the whole refinance thing. I mean, I know that I could go refinance my single family home as well. Although I can guarantee you in a 2 to 3 year time frame, or even 3 or 4 year time frame, I'm probably not pulling out my initial investment if I'm doing a refinance, unless market values have skyrocketed. What I thought was interesting is that you mentioned that the value of the property isn't as important as the value of the rents. And the fact that rents keep going up is what allows that refinance to happen, because then the value of the property is greater. Obviously, there's the benefit of multiple doors equals multiple income streams. And so if 1 or 2 of those doors goes vacant, I'm not out 100% of my cash flow, which is the case in a, with a single family home. Mm-hmm. And I actually thought before we had our conversation today that you needed a lot more to invest in this kind of syndication. I know you mentioned that off air we were talking, it's like, hey, there might be some rules around being an accredited investor versus not for certain deals, but I was actually surprised at how approachable this is for the quote unquote normal investor who may not be an accredited investor. And certainly for those who are, there's lots of options out there. So Andrew, thanks for taking time to sit down and explain this to a dummy today. This was really enlightening for me, hopefully useful for the people listening too. And for those who are interested or intrigued in this and want either more information or want to look into what it looks like working with you guys and what you actually do, how can they get in touch with you?
So you can go to my website. That's albinvestments.net.
Cool.
And my email is andrew@albinvestments.net. And you can call me on my cell phone as well, 801-707-0725.
Sweet. We'll drop all those in the links to our description, albinvestments.net. Go check them out. Andrew, thank you so much. I really appreciate you taking the time today, man.
Okay. Thanks, Alex.
Have a good one.